For more insights, let's cross to our guest, Mr. Liu Zhiqin, Senior Fellow at Chongyan Institute of Finance at Yunmin University. Thank you for joining us, Mr. Liu.
Thank you.
The market was fearing market liquidity tightening from the Chinese authorities this year as the economy has rebounded quite strongly from the pandemic last year. Do you see any tightening signal in the first 3 months of this year?
And actually, we have facts that there's no serious or very important measures that to tighten the liquidity in Chinese financing market, especially in the first 3 months. We can see that the situation in the financing market in China is very stable, very smooth, and very healthy. This is a very important signal for China's development at the moment. We can see very important 3 figures. One is the reserve, the saving still increasing in China, increasing by 25%. And the second figure is very important for us to know is the social financing also increased very steadily. So there's no any negative limits for impact from the pandemic or from the situation from outside. And the third is very important, the broad money, that broad currency, the M2 is still remains very stable as before. That means the balance is still about 2,000 trillion yuan. So this is a very good figure for China's financing market. That's quite stable and quite healthy. So we see that in the future, the situation will remain the same, that a very healthy development in the financing. From the central bank, PBOC has a very clear, very prudent policy making procedures to avoid any possible risks in the moment.
But China is facing a booming liquidity globally, especially from the US, where the Fed is printing trillions of dollars. How should China face challenges such as imported inflation and fluctuating foreign exchange rate and so on?
Yeah, that's true. That we can see that the impact of the U.S. Federal policy, they have some negative impact, especially from the money inflow from outside. But actually, we don't see any serious dangers that for so-called imported inflation, because China's financing policy is a little bit independent from the United States, especially. We don't have very close link with the U.S. The value at the moment. So that's why we always see that less influence or fluctuation that caused by the U.S. dollars. But from the capital market, we see some impact in the movement. We should be pay more attention to in this way that with China has to avoid such so-called imported inflation by tightening the measures from the money currency flow outside or inflow, so we can control all this hidden risk from outside, especially from those that the big financing giant in other countries that they want to involve in more detailed business in China's market, especially in the stock market. We have to build up our firewall against all this so-called imported inflation. But the exchange rate is always China's focusing, because we have very cautious about the exchange rate, and we don't see any reason that the exchange rate will be heavily or seriously influenced by the U.S. dollar, by the reserve policy. So in this way, that China's currency is remaining very stable.
Mr. Liu, you just mentioned the stock market. In the US, it's obvious a lot of money printed by the Fed has not gone into the real economy, but into real estate and stock markets. That's why we see their asset prices being pushed into record highs. How can China avoid such mismanagement and let finance serve the real economy, namely manufacturing and services?
This is really a very sharp discussion and also dispute, even in the United States, whether all this the overall printed money will go to the other side, especially from the property field and the stock market in the United States, that will damage the foundation of the U.S. economy. But actually, we have to say that there's no fears for Chinese market to be afraid of such things that are happening in China, because China and the United States, we have both different economic structure. In the U.S., I think the property market and the stock market is the main column for the development of the U.S. economy. That's why the U.S. economy has always developed according its own way. But China, as a developing country, we should still keep our focusing on the manufacturing and the real economy. The real economy, including the manufacturing and the high technologies and even the other field that are related to the people's daily life. So in this sense that we have to see that the big difference between the two structures in the U.S. and China, but we don't need to be worried and afraid of the U.S. negative influence from the property market or even from the stock market, because they have their own structure. They can meet their demands and also to deal with their problems. But the risks remains the same, that even for Chinese market, we should also build up our monitoring and supervision system to keep our mechanism to control the foreign exchange rate. This is quite important to fight against the so-called dangerous or even the negative influence from the outside, especially from the U.S. Dollar.
Thank you very much for your insights. That's Mr. Liu Zhiqin for us from your university. Thank you.